All right, let's dive right in. Today, we're going to tackle a really powerful options strategy. It's designed for one specific goal, to help you generate weekly income, but, and this is the important part, while knowing your exact risk right from the get-go. We're going to break down Nifty weekly credit spreads into a super simple step-by-step guide. So let's get into it.
So, does this sound familiar? You're looking for a way to pull some consistent weekly income out of the markets, but the whole idea of unlimited risk, like when you sell naked options, it's just a total non-starter. It's just too scary, right? Well, what if I told you there's a strategy that's built from the ground up to solve exactly that problem? That's what we're digging into today.
Okay, the key phrase here, and I really want you to burn this into your brain, is defined risk. Defined risk. We are talking about a strategy where you know your absolute maximum possible loss the second you place the trade. No surprises, no waking up in a cold sweat wondering what the market did overnight. It is all about being in control.
So, what in the world is a credit spread? Think of it like this. It's a two-part move that you do all at once. First, you sell an option, which immediately puts cash, a premium, into your account. But then, at the very same time, you buy another, cheaper option. And that second one, that's your insurance policy. The price difference between what you sold and what you bought lands in your account as a net credit. And it's this clever two-part structure that puts a hard cap on both your potential profit and, way more importantly, your potential loss.
All right, let's get into the nitty-gritty. First up, we have the bull put spread. And hey, the name kind of gives it away, right? Bull. You'd use this when you think the market is bullish, you think it's heading up, or even if you think it's just going to go sideways, just kind of chill out. Basically, you make money as long as the market doesn't take a big nosedive. So how does it actually work? It's really just two simple steps. Step 1, you sell a put option at a certain strike price. For example, Nifty at 23,800. Boom, you collect a premium. Step 2, to protect your downside, you immediately buy a cheaper put option at an even lower strike price, maybe 23,600. That second part, that's your safety net. That is your insurance policy. It's the piece of the puzzle that defines your risk.
Okay, theory's one thing, but let's see how this plays out with real numbers. Let's make this concrete. Imagine the Nifty is just sitting there at 24,000. What does the actual profit and loss look like for one of these bull put spreads? Let's crunch the numbers.
So check out how simple the math is. You sell the put for, say, 120 rupees. You buy your protection for 60. You do the subtraction, and you're left with an instant net credit of 60 rupees in your pocket.
And here's the cool part. That 60 rupees you just collected, that's also your maximum possible profit. You just multiply that by the Nifty lot size of 75, and that gives you a max profit of 4,500 rupees. That's your best case scenario.
Now, for what I think is the most important number on the screen, your risk. It is capped. When you run the numbers, your maximum possible loss on this trade comes out to 10,500 rupees. And that's it. It can't be a rupee more. You know your absolute best and worst case scenario before you even place the trade.
Okay, so that's what you do if you're feeling bullish. But what if you're looking at the charts and thinking, I think this thing is going to drop, or maybe just stay flat for a while? Well, for that, we just flip the whole strategy upside down and use what's called a bear call spread.
The setup is pretty much a perfect mirror image of what we just saw. This time, you sell a call option above the current market price, let's say at 24,200. And again, you collect that premium. Then, to cap your risk on the upside, you buy a cheaper call option at an even higher strike, like 24,400. With this one, you make money as long as the market doesn't have a massive rally and blow past that strike you sold.
You know the drill. Let's run the numbers for this one too, just so we can see how it all stacks up. Same scenario. Nifty is at 24,000.
And, no surprise, the math works the exact same way. You sell your call for 110 rupees, you buy your protection for 55, that gives you an immediate net credit of 55 rupees. Simple as that.
And just like before, that credit becomes your max profit. Multiply 55 by the lot size of 75, and you're looking at a potential 4,125 rupees for the week. And again, here's that all-important number. Your maximum loss is clearly defined from the start. On this trade, it's 10,875 rupees. Let me say that again. No matter what crazy thing the market does, you cannot lose more than that amount.
Look, no trading strategy is magic, right? Nothing is perfect. So it's absolutely crucial that we look at this with a balanced view. Let's really lay out the pros and the cons of using credit spreads.
Okay, so on the plus side, the risk you're taking is pretty small compared to your total capital, and it's a really accessible, retail-friendly way to use a little bit of leverage. Now, here's a huge advantage. Time decay, or what traders call theta, is your best friend. The options you sold are constantly losing a tiny bit of value every single day, just because time is passing. So as long as the market doesn't go wild, the trade is kind of working in your favor automatically. Now, for the downsides. Your profit is capped, you can't hit a home run. And you have to be careful, because in a really volatile market, a sudden sharp move against you can make you hit that maximum loss pretty darn fast.
Okay, so we've got the theory down, but how do you actually do this week in and week out? The key here is having a consistent game plan. So let's outline a really simple weekly schedule you can follow to execute these trades.
Here's a good rhythm to get into. On Wednesday, with the new weekly options, it's usually best to just sit on your hands and wait. Premiums are high, yeah, but the market's direction for the week is still a total question mark. The sweet spot, the best time to actually put on your spreads, is usually Friday or Monday. Then, by Tuesday, you're already thinking about your exit. You're looking to close the position and either book a nice profit, say 40 to 60% of the max, or just get out to avoid any of that crazy last-minute drama before expiry.
Let's get even more practical. Let's talk about actual capital. Say you're working with a 2 lakh rupee account, which is a pretty common starting point for a lot of retail traders. How can you use this strategy safely without going crazy and over-leveraging yourself?
And this right here is a fantastic, super simple way to think about it. If your market view is bullish, maybe deploy 2 bull put spreads. If you're feeling bearish, you do 2 bear call spreads. And now, check this out. This is the cool part. What if you think the market's going absolutely nowhere, just stuck in a range? Well, you can deploy 1 of each. 1 bull put and 1 bear call. That's a strategy people sometimes call an iron condor, and it lets you collect premium from both the upside and the downside. Pretty neat, right?
Okay, so we've gone through a lot. We've covered the definitions, the mechanics, the pros and cons, even a weekly game plan. But if there is just one crucial point you take away from all of this, what should it be?
This really is the bottom line, right here. With a 2 lakh account and the current Nifty lot size, credit spreads just offer a fantastic balance. Think about it. Your risk per spread is around 10 to 11,000 rupees, totally manageable. Your potential reward is a really solid 4 to 5,000. And with those numbers, you can safely trade 2, maybe 3 spreads a week. That is the recipe for consistent, risk-defined trading.
And that brings us to the final question. Really, it's the only one that actually matters. Now that you've seen how this strategy works, its structure, its absolute focus on defining your risk upfront, you have to ask yourself, could this kind of disciplined, controlled approach be a good fit for my trading style? That's definitely something to think about. Thanks for tuning in.